In today's video, I want to talk about whether you might need long-term care insurance. I think there's a lot of confusion around this topic. People obviously worry a lot about the cost of long-term care. Just healthcare costs in general just seem to be skyrocketing over the last few decades. So it makes sense to, want to be protected and think about your future, but a lot of people just haven't really put a lot of numbers to the actual analysis. So in this video, I want to go over kind of how much does long-term care actually cost, at least on average. How likely are you to even need paid long-term care? Then we'll get into long-term care, the insurance, how it works, what it costs, and then kind of just think about the present value of those insurance payments you're making and whether it's better to have any insurance, whether to self-insure, and how you should go about it. Now, my name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. So how much does long-term care actually cost? There's not necessarily just a ton of great data on this. I spent quite a while trying to research what I think was best. And I do like, there's a PwC study that came out back in 2017 that found that the average cost of long-term care in 2017 dollars was $172,000. Now, they updated that study through 2020 and found that it hadn't actually moved much and that the average lifetime cost of long-term care at 2020 dollars was $180,000. Probably fair to assume we're up a fair bit from there in the last 5 years, but I think that's a good starting point. One of the charts I want to show you from that PwC study is the estimated lifetime cost of care by percentile. So if you're in the, let's say, 5th percentile, your lifetime care is only like $2,000. That 50th percentile was like $107,000. For many Americans, a retirement is not going to derail them too bad, but all of a sudden you get into the 75th percentile, $240,000, the 90th percentile, $434,000, all the way to the 99th percentile, you're getting close to $1 million in long-term care costs. Now, there's another look at long-term care costs. This comes from Genworth and their subsidiary CareScout, and this is going to show you the median cost on a monthly and annual basis for the different types of long-term care. So we've got our in-home care, homemaker services, a home health aid. That's running around $68,000 to $75,000 per year. This is on 2023. Now, a community or assisted living facility, you're looking at anywhere from as low as $25,000 or $24,000 and change up to $64,000. And then the nursing home facilities are the most expensive. You can get a semi-private room, $104,000, a fully private room, $116,000, $117,000. And keep in mind, these are just medians. So I'm here in the greater Seattle area. I believe nursing facilities here cost quite a bit more. I've seen like Washington, D.C., for example, has very high cost. So where you might plan to actually get your care is going to make a big difference. Being close to family and loved ones, if they're in a high cost of living area, it may cost you more. So clearly, if you end up needing long-term care, it is quite expensive. And these costs, if we kind of break it down, they've been skyrocketing in recent years. So you look at these three charts, you can see first, we can look at assisted living facility cost. I mean, geez, over the last 20 years, they've pretty much tripled. So you're at almost, that 64,000 number. In-home care costs have really been ramping up as well. I mean, just look at that move from 2016 when we were close to 46,000. Now we're all the way up to 75,000. And then the third one too is just showing that private room nursing home cost. And that is just, almost a linear line up every year. So clearly this is, a concern on a lot of pre-retirees and retirees' minds, and with good cause, as these costs just keep going up and up and up. But then there's the other aspect is, okay, we know it's pretty expensive, but are you actually going to need it? We have a few different studies we can kind of look at here. So Health Use Services came out, and they found that a healthy 65-year-old male-female couple, the male 65-year-old has a 44% chance of needing some form of long-term care if they live to their actuarial life expectancy, and the 65-year-old female has a 56% chance of needing some care. that would combine to a 75% probability that at least one spouse of a 65-year-old couple will require end-of-life long-term care. U.S. Department of Health and Services, they came out with this ASPE research brief. Their results showed that 70% of adults who survive to age 65 develop some severe long-term care needs before they die. Now, only 48% actually receive some paid care in their lifetime. What's the difference there? Well, a lot of people end up getting their long-term care unpaid through family and loved ones. Now, one of the quotes I think was interesting from this ASPE research brief, and this is, I think, worth noting as you get into a lot of this research. I'll just kind of read you the quote. Many older people with LTSS needs, that's going to be your long-term services, they rely exclusively on family and unpaid caregivers. And most paid care episodes are relatively short. That's good to know. Only 24% of older adults receive more than 2 years of paid long-term services care. Only 15% spend more than 2 years in a nursing home. However, the lifetime risk of receiving paid care is not evenly distributed across the population. Lengthy spells of severe needs and paid care are much more common among older adults with fewer financial resources than their wealthier counterparts. So there actually is a big socioeconomic difference here. I think that's something to kind of pay attention to. Your individual circumstances are going to make a big difference in the likelihood that you're going to need long-term care. And as I kind of looked at some of these stats, it can be surprising sometimes. For instance, I had thought that an underlying condition such as diabetes would increase your long-term care likelihood. In fact, that's not true. It decreases it. Why? Well, because the diabetes, unfortunately, shortens your expected lifespan. Therefore, your odds of getting long-term care go down. Those with longer lifespans end up with a higher probability of long-term care. In fact, let's just look at that next. So again, from this HealthView services, we can see this table is showing a healthy 65-year-old woman. So if you're at 65 and you're healthy, what are the odds that in these 5-year increments, you're going to need long-term care? So between age 65, by the time you get to age 70, there's only a 5.6% chance that you needed long-term care. Between 65 and 75, now it goes up to 13.9. You can see by 80, we're at 27, 85, 43.9, and age 90, if you make it that long, the odds that you go from 65 to age 90, you have a 58.3% chance of needing long-term care. So it goes up to greater than 50% if you achieve that really long lifespan. However, I think once again, important to note that they do tend to be short durations. Okay, so now we know reasonably good odds that you will need some form of paid care, and that paid care can be quite expensive, although duration tends to be short on average. Now, what does insurance actually cost? Let's kind of look at this. I've got a table here from the American Association for Long-Term Care Insurance. They're looking at a few of the top providers. We're just going to pick an age 65. We'll probably look at a married couple, but I'll just show you the whole table here. So you can see a single male, age 65. If they get $165,000 in benefits, those level benefits assumes that it doesn't change. On average, that's going to cost $1,700. That's an annual premium. For a female, because they have got a longer life expectancy, that premium goes up to $2,700. For a 65-year-old married couple, that's going to be $3,750 combined. And you can see both for the male, female, and for the couples, there's options for those benefits to grow 1% a year, 2% a year, 3% a year, 5% a year, kind of taking into account inflation and the expectations of higher future costs. Now, when you're buying your long-term care, a couple things you would want to think about if you're buying insurance is there's a lot that's going to go into these premiums. Your age, your health, your gender, your marital status, other factors, the actual specifics of your policy. Oftentimes they'll have an elimination period, meaning you have to pay yourself for a certain period of time before you're actually covered. You have to trigger a certain amount of actual needs. They're going to look at your ability to bathe and eat and just kind of do those daily tasks on your own. And they're going to do an assessment to determine whether you actually get benefits or not. That can be kind of a whole convoluted area that has a lot of kind of controversy around it. But okay, let's kind of think about whether this is actually worthwhile or not for you. One thing I always like to zoom out on, when you think about insurance, I mean, by definition, an insurance company is trying to make money. These are not nonprofits doing it out of the goodness of their heart. And to the extent that these are private businesses, they have to try to be making a profit after their overhead, which means that on average, they are going to collect a profit. It is profitable for them to sell you a policy. And that's going to be true by fact, by definition, for long-term care policies as well. So keeping that in mind, you know that statistically, you're probably better off paying for your own if that was something that you could do, but your individual circumstances are going to matter so much. So let's just think about this from the perspective of a married couple, age 65. We are going to look at that. Okay, let's just pretend they're getting that $165,000 in benefits. And they're deciding, do we go for those benefits or do we just try to self-insure? So if they take that annual premium and they open up their own account and they segregate it and they just call it, this is our long-term care insurance account. Let's take that premium each year, put it in there and invest it. Now, if we assume that they're going to earn a return of, let's say, 7%, here's what it would grow to. So by age 75, 10 years, that account will grow to $51,000. So it would only cover less than a third of what the long-term care would cover if they needed to tap that money 10 years from now. But as we saw before, the likelihood by age 75, although that was just for a female, was only 13.9%. So not super likely that they would tap it in those 10 years, but you only have 1/3 of the value available. If they can make it to 85, well, then the account would grow to $153,000. That is almost the same value that they're getting in those actual long-term care. If they can make it in 85, going back to that female, there's about a 44% probability. So, I mean, if we just stop right there, you have a less than 50% chance of needing it by 85. Although as a couple, the odds are higher than that. And yet the account would grow to about the same value, a little bit less, but not that much less, than the value of those long-term care would actually cover. And then if they were able to actually make it to 95, those premiums or this account would be worth all the way up to $350,000. Clearly, this would be way better off. You'd have much more money, and if you didn't need it for long-term care, you could use it for anything else. Now, I think this is kind of an interesting example because you give more flexibility if you kind of self-insure this. So if, let's say, 10 years into retirement, your other accounts have grown a bunch. Let's say your IRAs or Roths or taxable accounts have grown more than you expected, and now you find yourself with maybe more assets than you thought you'd have at that point, and you did not buy long-term care, and you've got that account and you feel like you no longer need it, you can do other things with it. You can give it to charity. You can give it as a down payment to a child. You can set up 529 plans, trusts, kind of whatever. A lot more optionality and flexibility there than if it's stuck in that long-term care plan. And some of these long-term care plans also have things like death benefits and so on. That's just going to add to the cost, add to the complexity. Insurance companies love complexity because it allows them to sneak more fees in for you. So always be cautious of that. If we looked at all these kind of numbers in terms of what you're paying in those annual premiums and they bump up those benefits, the math's going to work out very similarly, where the higher the premium, the more that your account would actually be able to grow if you did that in lieu of health insurance. So I find for most of my clients, at least when we run the analysis, it tends to make more sense for them to sort of self-insure. The odds statistically that they're one of the ones who have those super, super high costs are not super high. Again, you got to be in like the 95th percentile to get your long-term care cost into the, let's say, $578,000. So oftentimes with people with a few million in assets, it's just easier to self-insure. The odds are low. You also have the flexibility of family members and loved ones taking care of you, which can kind of help a lot of people. And then there's the other end of the spectrum. If you don't have a lot of assets, would you consider the long-term care? Oftentimes the answer to me is still no, because Medicaid can step in. So if you quickly, if you only have $100,000, $200,000 in assets and somebody in a married couple goes to the nursing home, it can just make more sense to kind of blow through the $100,000 of assets. It doesn't leave the other spouse with much, but there wasn't that much to begin with. And now Medicaid is taking over and providing those benefits, and you don't have to pay out of pocket anymore. It's oftentimes those people kind of in between. If you've got a few $100,000 in assets and it's a married couple, and running through 200, 300,000 of those assets would really leave the other spouse destitute, then it becomes more challenging. And in a lot of cases, the math might say self-insurance makes sense, but that doesn't mean it's the best for that individual couple, especially if that's going to give them a lot of heartburn at night. So there's kind of that middle ground where for some people it can become interesting. And I think that's the challenge. We can only talk about these numbers sort of on average, but everybody's individual circumstances, everybody's individual health is going to be the real key factors in this decision. So hope this gave you a lot to kind of chew on. Appreciate if you share it with anyone else you think would benefit. Like the video and subscribe to my channel. Thanks a lot.